The foundation: understanding the basics. Let's begin with the fundamentals. Mutual funds, managed by professionals who actively pick stocks, bonds, or other assets to outperform the market. Index funds, designed to mirror the performance of a specific market index like the S&P 500, with no active decision-making involved. Key question: do you want someone actively managing your investments, or do you prefer to follow the market? Understanding this is the first step. Cost breakdown: why fees matter so much. Fees might seem small, but over time, they can have a massive impact on your returns. Mutual funds, active management comes at a cost. Fees typically range from 0.5% to 2% annually, plus potential sales charges. Index funds, lower fees, often under 0.2%, because they're passively managed. Example: if you invest $10,000 over 30 years with a 7% annual return, a mutual fund charging 1.5% might leave you with $57,000. An index fund charging 0.2% could grow to $76,000. That's a $19,000 difference. Visual aid: a graph comparing returns with different expense ratios over 30 years. Historical performance: who wins the long game? Here's the reality. Research shows most mutual funds fail to outperform the market over the long term due to higher fees and human error. Index funds, on the other hand, consistently match the market and outperform most mutual funds after fees are accounted for. Quick stat: according to a 2023 SPIVA report, over 90% of actively managed funds underperformed their benchmark index over a 15-year period. Risk versus reward: what's your investment style? Risk tolerance plays a huge role in choosing between these options. Mutual funds, higher risk, with the potential for higher rewards if the fund manager outperforms. Index funds, lower risk, offering steady growth by tracking the broader market. Pro tip: if you're new to investing, index funds can offer a safe and predictable entry point. As you gain confidence, you might consider exploring mutual funds for diversification. Tax implications: efficiency matters. Taxes might not be the first thing on your mind, but they can eat into your returns. Mutual funds, frequent trading by fund managers can lead to higher taxable events, like capital gains distributions. Index funds, fewer trades mean lower capital gains taxes, making them more tax efficient in taxable accounts. Example: if you're investing in a retirement account like a 401k or IRA, the tax advantage of index funds might not matter as much. But in a taxable account, it's a game changer. Accessibility, minimum investment requirements. Another factor to consider is how much money you need to get started. Mutual funds, some require minimum investments of $1,000 or more, which can be a barrier for beginners. Index funds, many have no minimums, and ETFs, a type of index fund, can be purchased for as little as the price of one share. Example: if you're starting with $500, an index fund ETF might be your best option. Diversification, a key investment principle. Both mutual funds and index funds offer diversification, but in different ways. Mutual funds can focus on specific sectors, like technology or healthcare, offering tailored exposure but potentially higher risk. Index funds provide broad market exposure, like the S&P 500, spreading risk across hundreds of companies. Pro tip: for beginners, broad market index funds like the S&P 500 are a great way to diversify and reduce risk.